studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
Up to this point, we've seen how investment transactions are tracked and how journal entries are recorded. Now we arrive at one of the most important concepts in corporate investment accounting. Mutual fund distributions are often much more complex than they appear. Let's look at what Trident initially sees. At year-end, the corporation receives an investment statement showing a mutual fund distribution of $10,000. At first glance, this seems straightforward. The corporation sees a single amount and may assume that the entire $10,000 represents one type of investment income. That assumption is exactly where many accounting mistakes begin. The key question is, what is actually inside that $10,000 distribution? This is where the T3 slip becomes extremely important. Unlike the investment statement, the T3 slip provides a tax breakdown of the distribution. Instead of showing one amount, it reveals that the distribution may be made up of several completely different tax components. Part of the distribution may be interest income. Another portion may be eligible dividends. Some may represent capital gains. There may be foreign income. And part of the distribution may even be return of capital. Although all of these amounts were received as part of a single mutual fund distribution, they do not receive the same accounting treatment, and they do not receive the same tax treatment. This distinction is critical. Interest income is reported differently from dividends. Dividends are reported differently from capital gains. And return of capital is not income at all. That means the accountant cannot simply take the total distribution amount and record it as one income entry. Doing so would produce inaccurate accounting records and potentially incorrect tax reporting. Notice the comparison at the bottom of the slide. The incorrect assumption is to think distribution equals income. The correct approach is to recognize that a distribution may contain multiple tax components that must be identified and classified separately. This is exactly why tax slips are so valuable. They provide the detailed information needed to determine the true nature of the amounts received. The most important lesson from this slide is the statement highlighted at the bottom. A mutual fund distribution is not one type of income. It is a collection of different tax components that happen to be packaged together into a single payment. Before anything can be recorded in the accounting records, the accountant must first understand what those components are. And the T3 slip provides the roadmap that makes that possible. This principle forms the foundation for properly recording mutual fund allocations and accurately preparing the corporation's financial statements and T2 return. In the previous slide, we learned that a mutual fund distribution is not a single type of income. A distribution may contain interest income, dividends, capital gains, foreign income, and even return of capital. The challenge for the accountant is determining exactly how much belongs to each category. This is where the T3 slip becomes one of the most important documents in investment accounting. Let's walk through the process used by Trident Investments. The process begins with a mutual fund company. Throughout the year, the fund earns different types of income from the investments it holds. It may earn interest from bonds, dividends from Canadian corporations, capital gains from investment sales, and income from foreign investments. At year-end, the mutual fund company prepares a T3 slip. This T3 slip provides a detailed tax breakdown of the distributions allocated to investors. Instead of showing one total amount, the slip identifies the specific tax character of each component. Once the T3 slip is received, the accountant reviews it carefully. This is a critical step. The accountant highlights each category and determines how each amount should be treated for accounting and tax purposes. Think of the classification machine shown in the center of the slide. The T3 slip enters the machine as one document, but the information is sorted into multiple tax categories. Interest income is separated into one bucket. Eligible dividends are separated into another. Capital gains are placed into their own category. Foreign income is isolated, and return of capital is identified separately from the income components. Each category has its own accounting treatment and may have different tax implications. Once the classification is complete, separate journal entries can be prepared for each component. Those journal entries are then posted to the accounting records and ultimately flow into the corporation's financial statements. The income statement and balance sheet are updated using the properly classified information. This process ensures that investment income is reported accurately and that the corporation remains compliant with tax reporting requirements. Notice the buckets shown at the bottom of the slide. They represent the accountant's primary objective, not to record the distribution amount itself, but to determine the true nature of the amounts inside the distribution. This distinction is extremely important. Without the T3 slip, the accountant would know the total distribution amount, but would not necessarily know how to classify it correctly. The T3 slip provides the missing information needed to make that determination. The most important takeaway from this slide is the statement at the bottom. The T3 slip tells the accountant how to classify the distribution. It transforms a single distribution amount into clearly defined tax components, allowing each amount to be recorded correctly in the accounting records, reflected properly in the financial statements, and reported accurately on the corporation's T2 return. That is why the T3 slip is such a critical document when accounting for mutual fund investments. Now that we understand how the T3 slip breaks a mutual fund distribution into its individual tax components, the next step is recording those components in Trident's accounting records. This is where many accounting errors occur. A common mistake is to take the total distribution amount and record it as a single income entry. While that approach may seem simple, it is incorrect. Let's see why. On the left side of the slide, we have a T3 slip showing a total mutual fund distribution of $10,000. At first glance, it appears to be a single amount, but when we look closer, we can see that the distribution contains several different components. There is interest income, there are eligible dividends, there is foreign income, there are capital gains, and there is also return of capital. The accountant's job is to separate these components and record each one individually. Notice the center section of the slide. Each component is extracted from the T3 slip and receives its own accounting treatment. The interest allocation is recorded as interest income. The dividend allocation is recorded as dividend income. The foreign income allocation is recorded separately as foreign investment income. The capital gain allocation is recorded as capital gain income. Each component is entered through its own journal entry and flows into the appropriate income account. These entries eventually appear on the corporation's income statement. Now pay special attention to the return of capital allocation. This is one of the most important concepts in mutual fund accounting. Return of capital is not income. The corporation is not earning new income when return of capital is received. Instead, the mutual fund is effectively giving back a portion of the investor's original investment. As a result, return of capital does not increase revenue. Instead, it reduces the carrying value or cost base of the investment asset on the balance sheet. This treatment is completely different from interest, dividends, foreign income, and capital gains. That is why return of capital must always be identified separately. Once all components have been recorded correctly, the information flows into the financial statements. The income statement reports interest income, dividend income, foreign income, and capital gains. The balance sheet reflects the investment asset, including any reduction caused by return of capital. Now look at the warning box near the bottom of the slide. It illustrates the wrong approach. Recording the entire $10,000 distribution as one income amount may seem easier, but it produces inaccurate accounting records and incorrect financial reporting. The correct approach is to separate the distribution into its individual components and record each one according to the information provided on the T3 slip. This ensures that the accounting records accurately reflect the true nature of the investment income received. The most important lesson from this slide is highlighted in the banner at the bottom. Never record a mutual fund distribution as a single income amount. Always use the T3 slip to identify the underlying components. Then record each component separately based on its proper accounting and tax treatment. When this process is followed correctly, the financial statements become more accurate, the investment records remain reliable, and the corporation's T2 tax return can be prepared with confidence and compliance.